stoic face. You've been called worse, Patrick. I got to say, you've been called
many times. In my mind, I'm doing far better because I got my smile sign up here. I move my head.
Ladies and gentlemen, welcome to episode number 47 of Rein It In. And on the last episode, we talked about mortgage growth. We talked about bogus housing starts. We talked about how inflation is slowing down. And in this episode, we're continuing the conversation with interest rates. We got Patrick predictions. The interest rate announcement has just happened. And then we're going to talk about unemployment and the economic trajectory of where this country is heading with regards to real estate. So stay tuned and get ready.
So if you're liking Rein It In, make sure that you subscribe. Let us know what you like, even what you don't like. Hit that button and subscribe.
Patrick, let's dive into interest rates tomorrow. So we're shooting this on Tuesday. The interest rate announcement is tomorrow.
We interrupt this program to bring you a special report.
Quarter point drop. Bank of Canada doing us a big favor.
I know 7 hours ago, the Bank of Canada comes out, drops a quarter basis points. Now let's refresh everyone's mind. Patrick, you predicted a quarter point drop. I predicted and in fact was hoping for what I call a double rate cut, which means 2 quarter points, so a half a point drop. That's what I was really hoping for because I think that it's the adrenaline that the market needs. The question is, will the market do with a quarter point drop? What's it gonna do to the market, Patrick? Specifically the real estate market. Let's start there.
Well, my view of it right now is I don't think it's going to do a lot. I mean, it'll be, where it's going to be somewhat helpful. I mean, your, let's say average mortgage payments $2,700. Now it's going to be $2,600. Like it doesn't have a meaningful effect. Having said that, for investors who were tight and when they got caught, for example, like many of us did, me included, you included, variable rates, and it will help in terms of a little bit of extra cash flow. I mean, I'll take it wherever I can get it while rates start to continue to come down. So that's kind of my view. I don't think it's going to have a big impact because what hasn't changed is affordability. Prices are still high. I mean, they're not 2022 or 2021 high, but they're still very high relative. And, people, as much as we think that quarter point might make a difference, I'll be very surprised if it does.
Are you ready, Patrick? You're going to be shocked at my answer. I'll tell you, you're going to be shocked. So at Visture, in case people don't know that are watching this, we manage properties obviously for ourselves, but also for we got 200 clients across Peterborough and Lindsay and Aurelia that we manage properties for. And I'll tell you what, I think this is going to hurt the market, not help the market. And I'll tell you why.
Isn't that interesting?
And I know this is not something JG typically says. It's pretty rare for me to say this. But the reason, Patrick, is because the market needs an adrenaline shot to get over the hump. And this little minute quarter point will only delay sales. I think people are now kicking the can down the road to spring. I think we're in the wait and see game. This is going to hurt the market, not help the market. Yeah. But I think that there is a tidal wave of deals coming through the market. Now, we don't sell real estate at Visture. We're a property management. We do construction, we do renovations, we do coach homes, we do densification projects, we do development. So we're only in the investment game. We don't sell real estate. But I do think there is a buildup of a tidal wave that is building up here. And when it lets go, it's going to let go. This is only going to make that worse. That's only going to make that worse. But for the current market, this fall market, it's going to hurt, not help.
Interesting. It could be that tsunami that you're talking about because I don't know if it'll be pent up demand, but I did hear somebody else give that similar view, a realtor, I think it was. Particularly in Ontario, you're going to see this have that effect. British Columbia, Alberta definitely won't have too much of an effect. If anything, Alberta will fire up a little bit more. But I think you make a really good point for BC and Ontario particularly, and that is that people are anticipating now another quarter. So they're going to kind of just delay. There may be a few sellers put some more inventory on the market, maybe, but I think you're right. I think it's going to cause a wait, which is not good because it is going to create an even bigger slowdown in the real estate market than we're experiencing in Ontario and British Columbia right now, which is very slow. The condo market in Ontario is, using the term melting down, is not a offside comment. It's actually what is in fact happening. So you're right. A quarter point is just a big nothing burger. Did you listen to some of Tiff Macklem's speech by any chance? Did you get some
No,
sound bites?
listen, I rely on you to do all that heavy lifting, Patrick. So tell me,
Yeah.
tell me what did you say?
Well, listen, I wasn't even really, I wasn't even going to make a big deal of it. I'm glad we're doing this, and I don't have a problem. But I was pretty calm and going, big nothing burger, no big deal. Kind of anticipated it, but I got really fired up. Two parts. Number one, Tiff gets on there and he goes, we're just responsible. We want to keep inflation. We're as concerned about inflation going under 2% as we are over 2%. So in other words, that 2% is what they say supports the economy. And my only comment of that is that we have agreed that them slowly robbing us 2% every year is okay. So, when you think about it, what does it take to stay ahead of 2% inflation? And we know that particular inflation number is always understated in terms of what the costs are in reality. So that kind of pisses me off. But then Trudeau and Freeland, their incompetence is beyond belief, when it comes to these kinds of things in finance. They both stood up and going, our plan's working, good for us. We are doing everything we can to support Canadians. Our plan is in place. Interest rates are coming back down, as if they're taking responsibility for it. And I want to shake them and go, okay, interest rates come down. When, JG? When do interest rates come down?
Usually when things aren't looking so rosy.
When things aren't looking so darn good, right? The economy is going for crap. So we got to start to lower rates before it gets out of hand. But I think ultimately, the landing is going to get a little harder than people anticipated. And I think we got to kind of be heads up around that. Now, that's going to be more regional than cross country, but I think that's what's going on, and we got to be aware of it.
Two, I got a couple comments on this. If people are still listening to this, and I hope they are, I said this is going to hurt the market. And I think, and I want to be very, clear about what I mean is I think it's going to hurt the overall numbers in the market. Deals are not going to move. Things is going to sit around. Now that's going to hurt, and that's going to feel like pain, especially in the headlines, especially to the average person out there, like that's kind of want to sell, especially those that want to sell their property. But this is
have to sell.
But this is actually a really, 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 really good position for investors to be in, because interest rates are coming down. This is becoming a Goldilocks scenario for investors, Patrick.
I love GG. I gotta say, I just love when you put on your rose-colored glasses and then start looking at the world through your rose-colored glasses. It's my favorite thing about you.
This is a Goldilocks scenario, and I'll tell you why. Okay, Patrick, don't make me laugh. Interest rates are coming down. Okay, they're coming down. In fact, the consensus on the street right now is they're going to be going down another 1.75% between now and the end of now and 12 months from now. So by September 2025, they're going to go from an overnight lending rate of 4.5% down to 2.75%. That's the general consensus. That's what the forward-looking markets are predicting. So that we're on the backside of rates going up. So that's number one. Number two, I truly believe, Patrick, there will be a tsunami. And now, how big tsunami is has a big visual effect to it. People expect, but there is some pent-up demand. How much, I don't know, but there is some pent-up demand, no doubt, in the real estate market for sure. This, I think, is going to hurt that, because instead of releasing some of that pent-up demand, it's going to build it up even more. But from a Goldilocks scenario perspective, as interest rates come down, for those investors that are looking to buy, they're going to get the best possible deal with the rates coming down. And when that pent-up demand releases, prices will follow. That's a for sure, Patrick. That is a for sure. When it releases, the prices are going to follow.
You're talking definitives here, buddy. When you say for sure, of course, this is not real estate investing advice. We're just a couple of weirdos on Facebook Live.
Super weird. I'm betting my stuff on it, but I'll tell you this though, Pat. These are the decisions I'm making for myself, Patrick. But here's what I am saying is, and I'm not saying, because it will over time go in that direction. I'm not saying it's all going to happen in the next 3 months here.
Yeah, right? For sure.
And that's important to realize, is that timeline has a lot to do with real estate. But that's why I'm calling it the Goldilocks scenario, which is interest rates, are going to continue to come down. How much? Is it 1.75? Is it 1.5? Is it 1.25? Is it 2.5? We don't know, but we're on the backside of the slide now. That we know is definitely happening. And we know there's pent-up demand. We know when pent-up demand releases, prices are going up. And if the investors make their calculated moves, this is a great entry point into the market. That's what I'm saying.
Well, prices will have to move a little bit. I think that we can't overstep that one fundamental fact, and that is we still are limited in terms of supply. So as much as purpose-built rentals are high on the list of things coming on, condo market, it's still going to be crap. Single family is still an issue, or even single family as in multiple, like not five units or less, as opposed to multi 5 units or more. So when we look at single detached and those types of units, they're still not being built. There's still a supply issue. But here's the fundamental issue that we're got to just get grounded in. And I don't want to be always the doom and gloomer of this, although I seem to be that.
You're not a boomer. You are a boomer, but you're a doom and gloomer and a boomer.
Yeah, exactly. I'm not a boomer. I'm a doom and gloomer. But no, I think we have to consider that my concern with it all is that, to your point, I don't disagree with you in terms of things are going to kind of crawl along in the real estate world. The challenge that faces, because people are waiting, the challenge we face is our economy is driven, 8 to 10% of our economy is driven by real estate. So we slow that down through the fall and winter. I mean, there's a lot of realtors sitting there going, if I gotta sell some stuff, I gotta get some things moving to pay the bills. So, but it's not just realtors, it's everything to do with real estate transactions. That goes to mortgage brokers, it goes to lawyers, it goes to everybody who's involved in that. People that work within the municipalities, the bureaucracy that, makes the world go round. So my point is that as real estate, if it slows down like you're kind of forecasting it will, and I don't disagree with you, the economic impact could be quite harsh. That would be my big concern about it. And sadly, I do disagree, or I do agree with you. But let's go back to trash talking Freeland and Trudeau. This is really the issue here. The incompetency, but the good news is, to whatever it means, we don't know. That's Jagmeets ripped up that agreement with Trudeau. Woohoo! What does that mean? We don't know. It could be nothing but, bravado and show and yeah. And I mean, he's out. I mean, NDP he's crushed that party, and so it should be. And that's the way I see Freeland and Trudeau in their level of incompetence is just still there. And that's what it is. That's my rant, and I'm being quite polite in my expression of it.
Yeah, you weren't that polite offline a while ago, Patrick. But now listen, you made a very, very good point, Patrick, which is I made all these statements about the Goldilocks scenario, but I do want to qualify, and I do want to specify that I'm in the world of single family duplexes, triplexes, fourplexes in very good markets. I mean, this isn't, real estate is not like a general, it's like, where's the weather going in Canada right now? There's a lot of answers to that. It's storming here, it's sunny there, it's raining over here, and it's snowing in Calgary, because it seems to always be snowing in Calgary. But, it's the same with real estate. So that, my Goldilocks scenario really is outlined to that single family, especially when you add a secondary suite, especially when you add a coach home to it. Right now is a phenomenal entry point into that part of the market. Condos, I don't even want to talk about condos. I always hated condos, Patrick. I've never been a condo fan.
Yeah. Well, I'm less of a fan because sadly I own some. Listen, I've had them long enough to pay for pretty much. But anyways, hey, and because we've got a couple of viewers on there, I would like to know if you guys can tap in. What do you think? How do you see the interest rate drop? Just type it in there. Is it good or bad? You don't care.
I will tell you, Patrick, that, and I'd love to hear from the viewers and those of you listening after the fact too. Please put it in the comments. But I will say, Patrick, that and I speak to, just like you, we both speak to hundreds of real estate investors every single month. And, there's no doubt real estate investors have been wanting and needing something positive, something to bite into. And even though these quarter point drops are not huge, it is moving in the right direction. It's a hell of a lot better, dude, than a quarter point raise. That's for sure. And it's also better than them doing nothing. So it's moving in the right direction. And, things like, because credit cards and because lines of credits are based on variable interest rates, those payments are coming down, and stuff that wasn't feasibly possible. Like, let's just say somebody was trying to do a secondary suite in a basement last year, and they couldn't because the interest rates on their lines of credit was 7.5, 8.5%. Well, now those interest rates are in a much better place now. I checked earlier today, and I'm able to get like line of credit money for in the high fives, low sixes. I mean, that makes the deal, that makes it feasible again, right? So, not everybody's a doomer, gloomer, boomer. You know what I mean? Like,
Doomer, gloomer, boomer. That would be me. Well, listen, and sadly, I'm so in the kind of research of it, and I see a much bigger picture. And that's not to say I know more. It's just that I'm inundated more. It's hard to be optimistic when you're getting hammered with all the bad news side of things. I want us to say
you
this.
need some new glasses, Patrick?
I do. I need that rose-colored pair. So one thing I want to bring up is that we talk about Goldilocks. We talk about real estate. I'm going to be speaking at the Real Estate Investor Conference in Edmonton, September 22, 23. REIN members, if you're watching this, go and register for that program. Use REIN, REIN 10, and get a discount. It's a very inexpensive weekend. Some great speakers lined up, and we're going to be updating people on what's going on in Edmonton, in Alberta, talking about real estate. I just wanted to mention that here, right now. So next rate is in October. I think it's October.
November. I think it's early November. It's
early
like November.
Okay, so September. Yeah, you're right. Early November, probably another quarter, probably, and we'll see what happens there. I don't know if there's one in December as well.
The consensus is that we're going to get the consensus yesterday before today's decision was 3 rate cuts before the end of the year. 3 rate cuts. That could have happened. What I was hoping is a double today and then a single on the next one. That's what I was hoping for. Now, the fact that they went single, Patrick, I'm holding out for my double prediction. I think the double might happen on the next one.
Maybe. I hope you're right. I mean, I'm not going to complain if we get a reduction in interest rates, but let's really consider what that really means. And what it means is the economy's not doing all that well, and they're being generous, and they're going to give us only 2% inflation. They're only going to steal 2% of our money every year. No big deal. It's only 20% over 10 years. Gosh, we'll hardly even notice, so that gets me fired up.
It's actually much more. It's actually much more than 20%, Patrick, because it compounds, right? So
of course. But anyways, we didn't want to go down that rabbit hole. Okay, well, hopefully that's our view of what's going on. Rein it in. This is what's happening. This is how JG and I see the world today. It's really about the incompetence of our government and even our, Bank of Canada, Governor, Tiff. These guys, they got to go. We need better leadership. JG, you and I should,
Patrick for Prime Minister. I've been saying it for years. Patrick for Prime Minister.
Trust me, I wouldn't last 3 minutes.
And now back to your regularly scheduled program.
Well, I think we got to clear up a couple things. First and foremost is that we're talking primarily of the devastation within the condo market. We know that we go back often. We say to investors, potential rental housing providers, those that are considering it or who are in it, the single family space is a space where the trajectory of building is down. Alberta might be the exception to that rule. But having said that, where the big devastation is happening right now is in the condo market, primarily in Toronto / the GTA, but is also happening in Vancouver. Prices are coming way off. Builders are in big trouble. And this also translates to a couple things that we've talked about now for over a year, which is it's already starting to happen, which is the job losses within the construction industry. So when we talk about the economic trajectory, remember, we say within the long-term real estate success cycle or the success formula, we look at GDP, we look at job growth, we look at population growth. Well, what we've got is population growth, but we don't have job growth. We look at the public sector has been the majority of jobs, not the private sector. The increase in salaries has been primarily in the public sector, not the private sector. So we're lacking the productivity that is required within GDP. What we've got is a bunch of administration and bureaucracies doing all the things that they do. That's not productive. That we're we're paying them through our taxes, so we're not generating really new revenue, new productive revenue. And so the trajectory, and now is where we're going to hit the leg. Consider the fact that, well, are we in a recession or we're not in a recession? Arguably, in some areas, we're definitely in recession. Some industries were in recession. We now look at 12 months down the road, given the trajectory, and I don't think, again, back to Bank of Canada, I think we're going to be hard pressed not to hit an overall real true technical recession. Will it be a hard or a soft? Too early to tell, but the trajectory is definitely in the next 12 months going into recessionary territory. I think we'll start to see that. We could see that in 2025, a true recession, technical recession, given the trajectory of what's going on, because that's the lag that we're seeing. That's kind of my view of it right now.
Yeah, it's it's interesting, Patrick, and I think that whether that happens or not, and we always are encouraging, and I know you and I both do this, but investors must look further down the road than they are right now. And the fact is, you're not investing for real estate for the next 12 months or 24 months. You're investing in real estate for the next 12 years or 24 years. And I think that that's really critical. And investors have to remember that, because there's two things. And I want to come back to what my realtor friend, because realtors are the exact opposite. Realtors, they're not investing for the future. Realtors are worried about deals like this week, today. Like,
What am I closing today? What am I doing this month?
realtors measure stuff on how many deals I closed in a month. So they're very nose to the grindstone. I got to tell you, man, I made some phone calls last week and I said, what do you think? What do you think the Bank of Canada is going to do? I got one realtor friend, great guy. He's one of the top performers in this market. He's amazing. I love working with him, and he's got such a great view. He said, JG, if they don't do a double rate cut, and you know this guy, it's not who you're thinking, but you know this guy too, Patrick. He said, JG, if they don't do a double rate cut in early September, it is not. If they do a single rate cut, it's not going to be enough to spur the market, and we are going to push this entire market straight to the spring. There's going to be no fall market. There's going to be no winter market. It's going all the way to the spring. He says, if they do a double rate cut, in his
double
opinion,
as in a 0.5. Are you talking about
0.5? Yeah, I'm calling it a double rate cut. Yeah. Double 0.5. He says that would be enough in his opinion to spur things. But he's really pushing and hoping for a double rate cut. That's his opinion, and I thought that's fascinating. Now, of course, this guy, he's in the business of selling real estate. He wants to sell deals like September, October, November. But as a real estate investor, you got to be looking way into the future. And one of the things I am looking that is coming into the future is the banks are starting to get very creative, Patrick.
They're getting aggressive. They're competing. They got to lend money to make money, and they're the IMF, and they're being shut down. They're having to increase reserves. They're not making money. By the way, banks are stating losses, so not good for their stocks. Patrick, banks are a mess. So we digress. But anyway,
but this is very important, because that will spur the market too, Patrick. Don't forget, they've been tightening lending conditions for some time. I'm getting phone calls from mortgage brokers telling me what the banks are doing, because they're loosening up and they want to put some money to work. So this is coming down the pipeline too, right? So everybody knows we're at the pinnacle of tightness right now. It only goes one way from here, and it's looser from a money management perspective, or money flow perspective. And that's a very good thing for real estate investors, because if you've gotten this far, and if you've gotten, if you were able to survive this much, well, you're on the backside of the hill now, and you're now heading into a better territory. That's the way I see it.
Well, and I don't disagree with anything that you just said. I think there's a couple of things that we want to shine a light on, not the least of which is that there's a lot of investors out there who got caught. And, you and I both had variable rates, and, all of a sudden, bang, the next thing you know, our rate is 6.5, 7. I got a commercial loan. I think I renewed for another year just recently. I think I'm at 9% or some ridiculous thing like that. So first off, the existing, let's say, group of investors that are they got hit, they're going to start to feel some relief with these rates. That's good, because it starts to bring some cash flow back into some of the real estate portfolios that are bleeding. And that shuts people down. Let's face it, if you've got a portfolio of 3, 5, 10 doors and you're upside down because of getting caught with increasing interest rates. Well, listen, anytime you can get some relief, $100 here, a couple $100 there on a portfolio of 3, 5, 10 doors, it makes a big difference. So I think that's the good news around it. Let's break it down even further. And that is that bond yields, by the way, I mean, we know that there's sub 3%, 2.98, 3.02. So when we see bond yields, 5-year bonds, we know that that fixed rate's going to also stay quite manageable and it will start to come down. Banks need to be competitive in that regard. So although I look at the market and I look at the economy and I see this trajectory going the wrong way, I want to be really clear about something, and that is it doesn't change what I believe and what I've seen over many years now is real estate investors need to stay engaged. This is where opportunities. I recently did a FUD video of real estate, fear, uncertainty, and doubt. And that's what's happening in the real estate industry. And you can either sit on the sidelines and totally ignore it, or you stay engaged and see the opportunities that are going to present themselves and then take advantage of those opportunities. Because within the single family and small multifamily space, we need supply. Immigration, they're talking about slowing it down. I'll almost guarantee you it won't slow down enough to make a difference because we can't, because this was driving our economy for what it is. And so as rental housing providers, as investors, these are in fact the opportunities, which is really tough because it takes courage to be in this market when everything seems like it's hitting the fan all over the place.
There's a couple interesting things you said there, Patrick. Speaking about immigration, I want to dive into that. I don't think it's on our docket, but I do want to dive into immigration specifically around students because that does have an impact on student rentals, and I am seeing some serious waves in that market. So I want to come back to that. But at the end of the day, right now, and I've been saying this now for probably 6-8 months, but it's truer now than it's ever been, which is, the time is now. If you're thinking, this is the way I look at it, Patrick. If you're thinking let's just say I had your view on it and I thought the next year is going to be quite tumultuous. Let's just say I had that view. Right now is the perfect time to be negotiating deals. And if you think it's going to be tumultuous, then what you need to do is factor that in to your probabilities and factor that into your negotiation and chop a few points off the purchase price of some of these things and go in a little lighter than you think you should. If you think the thing's worth $550,000, offer them $520,000. Buy yourself that probability of success. That's the way professional real estate investors and really good real estate investors do it, because now is the time to negotiate. I recently, just last week, finalized a negotiation with an organization here in town. And I got to tell you, Patrick, we were able to negotiate essentially double the value of what I thought we would get. Okay, so the deal's not public yet, so I can't get into details. But the point is that we got double the value. So let's just say we're negotiating a $250,000 deal. We were able to get $500,000 worth of value to us for the $250,000 deal. Now, why does that happen? That's because everyone is hungry right now. Business owners are hungry. Partnership deals are hungry. Everyone's hungry for success. So as a result of this hunger, it opens up opportunities. Now, as an investor, I'm not investing for today. I'm investing for 2 years, 5 years, 10 years, 20 years down the road. You're going to be very thankful of those deals you cut today. And if you're worried about the probability of success, just add that layer of protection for yourself. That's all you got to do, really.
What we do here, this is calculated, okay? We weigh the odds, we make a choice. This is it.
Well, I think there's a couple things that we don't want to step over in all of this, right? Which is, for example, you talk about looking for deals and seeing the opportunities. That comes also from working with a great realtor. Now, what's interesting about what's going on in the world right now, the realtors who are staying engaged, who are surviving through this, are those that have been through these tough times before. The realtors that became realtors through the boom cycle of it. Everybody was becoming a realtor because that's how you made money, and you're selling $1 million homes and you made really good dough. And those individuals are now out working for a living in another job. There's certainly realtors that have actually continuing to do quite well relative to what's happening. That's because they're experienced, they're the grinders, and they're the individuals that are bringing deals to the table if you're staying engaged. So in other words, who are you surrounding yourself with? Who have you got on your team? And I can't stress enough is that this is not the time to ignore what's going on. I get it. If you want to sit on the sidelines and not put capital to work right away for whatever reason you have, that's fine. But don't just ignore what's going on in the world, because that's where you're going to miss opportunities, and you'll look back a year from now and go, oh, maybe I should have paid closer attention, because you're going to start to hear stories from guys like you and guys like the investors in general. So we've got the Real Estate Investor Conference coming up in Edmonton on 22nd, 23rd. I want to mention that, September 22nd, 23rd. And I'm telling you right now, when you get into Alberta, for example, this Real Estate Investor Conference, how many people are coming in from out of province into that conference? Great range of speakers, totally focused on what's happening in Alberta, real estate investing, et cetera. My point is, you don't have to sit on the sidelines. You can do an event like that, stay engaged, meet people, hear what's going on for real with people that are in the trenches investing today, rather than totally ignore it. And I think that's a critical part to growing your business of investing in real estate. That's part of treating it like a business.
Now, Patrick, not on the docket today, but student rentals and specifically student immigration. I got a couple sort of in the trenches stories here to share because number one, I'm seeing some real slowdown in the student market for sure. I mean, at this time in August and right now, as post-secondary school resumes, so to speak, or starts again, typically we would be hammered with applications, phone calls, text messages, people looking for housing in the student rental space. Much, much, much quieter this year by a factor of 10, like way quieter. So it's very interesting to me, that component. So, those people, and I've always said to be very careful. Some people go all in on these student rentals. They transition their entire portfolio into student rentals. I've always been careful of that tactic. And a lot of people are kind of stressing out about that. That's number one. Number two, I have a friend of mine who's a professor at some colleges around a college here in the GTA, and enrollment, they thought, so enrollment used to be way higher. They thought they would fill their reduced expectations was 2 classes of 60 students for this particular program. Program's not important. 2 classes of 60 students each. Okay. Guess what they actually got? They only got 1 class with 39 students. That's how low the actual enrollment is. I mean, it's a real big deal in this, and that has a ripple effect. Has a ripple effect for housing. Has a ripple effect for all kinds of things. But interesting, because this was the hot market a couple of years ago. That I'm seeing as very, very different now in the trenches.
Yeah, lots of those things are changing. Maybe they're tightening up a little bit on students, but a lot of it is, I think, related to cost and students coming into this environment. And I think that's also, again, regionally specific. So what you might see in Kingston, Ontario versus Toronto versus Vancouver, totally different. And then there's a lot of students coming over on student visas into, this is where the fraudulent part of it is actually been seeing a lot of that show up. Like, I think in Vancouver, there's the New York, what do they call it? New York College in Vancouver. And it's totally bogus. It's recently been busted, kind of. And the point of it is that they actually had students that are enrolled in that. They get their student visa, and then they get here, and then they shift that student visa into a working visa through whatever channels and through whatever system. So they're just working the system, is my point. So again, regionally, you have to look at what's going on in that student housing sector and be really aware of it. I want to talk about unemployment. Now, anybody who's heard us and heard me, we talk about unemployment, and where the number at 5 and 5.5, 4.5, those are ridiculously tough numbers to deal with. Now what we're dealing with is rising unemployment, and depending on where you're at, we're at 6.5, 6.7. And to me, that's not a panic at all in terms of unemployment. Part of the issue that we've got, and part of the unemployment, is the fact that I've used that analogy where if you take a cup and you start pouring water into it, you only have so much capacity. And if you keep pouring water into it, the cup overfloweth. Now, that is part of the issue that we're dealing with our immigration. So people coming into Canada, there's only so much capacity within the system. We're starting to see that the cup is overflowing. In other words, unemployment is going up, but if we break it down and kind of look underneath the hood a little bit, you start to see that a lot of the jobs that aren't being filled are those service jobs, service sector jobs. McDonald's has a job and 500 people apply for it. So it looks like unemployment is worse than it actually is. And this isn't to minimize the actual pain that many are going to and are starting to feel in the construction area. So depending on the industry, we're starting to see that kind of unemployment number rise, and we got to pay attention to that. But we have to look at it from a sector given immigration.
I'm not feeling any particular pain around that, Patrick, in the sense that, like you said, I mean, it's made hiring easier, better. We're getting a lot more, we're getting great results. There's a lot of great talent out there. I mean, I through my marketing agency, we naturally just play a role in a lot of hiring for a lot of different companies because we do marketing for that, which is, hiring is a marketing role, really. And we're seeing a ton of we're seeing a lot of, an immense amount of immigrant applicants. Like, you put out a job posting and you get flooded with immigrants applying, which is fantastic. A lot of great talent out there. And then the other thing that I've noticed, especially in the last, I would say 3 to 4 months, is a lot more people are now open to switching jobs. I call them job switchers, where they're going from one particular, they're doing the same thing, but they're just now willing to try something else, or willing to try a different company. And we're seeing that pretty much across the board, which I find interesting, because you didn't find that 12 months ago, 18 months ago. They were where they were, and they wanted to stay there, but now they're open to ideas, they're open to thoughts.
Interesting. I think this goes back to the sector, but I want to just shine a light on it again. That I've said all along that, that 6 to high sixes, under 7% unemployment is still a really healthy unemployment rate. It just is. It keeps wages in check. So that's part of inflation issue that we deal with, is increasing wages, but it also gives you options in terms of the people that are coming in. You can actually fully staff a team without the stress of that. So you become more productive, more efficient. You have happier employees because you're not feeling the stress of being short staffed. So there's a lot of upside to that 6.5%. So we're going to keep an eye on that unemployment rate. My concern is, and continues to be, that we keep hiring public sector. That is not productive. And so as much as the unemployment is at 6.5%, when we unpack the numbers, you start to see how much is public sector non-productive type jobs. That's the concern, because the economy is being hammered in that regard by not being productive. Exports being one of those issues. Manufacturing continues to be very, very soft. R&D, all of those things that drive an economy. So we have to pay attention to it and not just buy this particular number. Let's look at what's underneath the hood in terms of where is that unemployment, because you're going to see some sectors where unemployment will be higher than 6.5%, and then you're going to see others that it's going to be 5.5%. And so that's where you have to break it down a little bit more. There was something else that I wanted to add to all of that, which is when we look at what's happening in Alberta right now. For example, it is the economy that's going strong. Oil continues to increase in terms of production, all of the things that are happening there. And again, we're running into a capacity issue. So what is the job availability? And as people move into that province, you're going to see a very high unemployment number, but everybody who can work is working given the jobs that are there. But then you add more people to that limited capacity, and you're going to see a spike in numbers. So these are things that we have to keep an eye on and look under the hood. Having said all of that, let's go back to real estate and then being an investor. We look at what the economy's doing, where it's going, the lack of supply, the ongoing immigration, interest rates getting stronger, better, more feasible in terms of making the math work. You need to keep looking at real estate as a hedge against the costs of living. And JG, there's another slide that we need to look at, and that is around where real estate is versus wage growth. Now, we show this slide, but this one is an updated one, and you start to see that we go back years ago when buying a house was 4 times income, or whatever the number is. Now it's 11 and 12 times income. Seems absolutely off the charts. And many are thinking that it's going to crash. It has never. It'll come down a little bit, but you're not going to crash. I don't see it happening in real estate overall. I mean, again, when I say overall, I see the condo market putting in a big correction, but that's a supply thing.
Yeah, I think that one thing that seems fascinating to me is the relationship between interest rates and the price of real estate. And it seems that, no, and I don't have a chart for this. I wish I did, and maybe on the next show we'll show a chart, Patrick. But there seems to be this. It seems to me that it's very clear that as interest rates come down, the price of real estate will go up. I mean, do you see that connection, Patrick? It's a pretty basic connection. Would you not agree?
Well, again, yes, 100%, but it's not the only factor. And when we look at the numbers, when we look at housing overall, and we look at the numbers, even the condo market, they keep talking about it's down 20% or 30% from all-time highs. Now, that could put us back into 2018 territory. So if you had a short-term view, if you were that speculator that bought condos with the plan of assigning it, not taking possession of it, all of the things that were happening in that pre-built condo market, yeah, it's pretty messy because you only had a 3-4 year view of the world, and then you're going to have to take possession of it, and you were actually gambling on those prices going up, and you get caught, the music stops, and of course we have the issues that we have right now, which is a condo market, particularly in Toronto, GTA, Vancouver, that is literally melting down, particularly in Toronto. And we're only getting warmed up in terms of that meltdown.
Here's an interesting chart, Patrick. Speaking of that, in terms of where prices are at compared to where they used to be, and I like this chart because it goes back to 2004. Now, this is specifically for GTA, but it does show you single family versus condo market. And you can see, you just said an interesting thing. You said, are the prices back to 2018? Well, based on this chart here, the prices are back to mid 2020, essentially is where they are. They're not even close to 2018, like not even close to 2018, 2019, 2020. Mid 2020 was the last time we've seen these prices this low, essentially is where the benchmark is right now for GTA.
It is right now. And that's on a aggregate kind of point of view. So if you get into specific markets, you're going to see worse, and then you're going to see better. So that's really, where things are at. So when we look at what's going on right now, ultimately, we still have Canada as a place where we are seeing significant population growth. They're talking about the foreign workers, temporary foreign workers, cutting back on that. That will have some impact, but I don't think they're going to cut back in a meaningful way. I think they're going to play this out, and they're going to keep it going as long as they can, because that literally is why we have the GDP we have. And it's basically just people coming into the country spending money. I can't stress that enough. That's the number we have to watch and what we have to pay attention to when we look at the economy overall.
So two things, Patrick, you just touched on population growth. So here's an interesting chart that shows, all the different decades from 81 to 90 and so on and so forth. And you can see that they're all relatively the same curves. And then you have the 2021 to 2030 curve, which is just crazy. My question for you, I mean, this is not surprising. Everyone should know this if they're connected at all. The question is what is the rest of the decade going to look like, Patrick? Do you think that this thing goes sideways now for the next 4, 5, 6, 7, 8 years? Or do you think that, because it's a big departure from what it's been like. So where do you think this goes?
We're going to have a government change in between all of this, right? So that's the thing. I don't know. I really don't know. I think that they're going to slow things down, and it may go sideways, but I don't know the answer to that question. I don't have one.
Because if you look at every decade, pretty much it's been somewhere, but roughly, I'm just averaging this number. It's essentially been roughly about 3 million people over the course of 10 years we bring into the country. That's been the average since 1981, according to this chart. Meanwhile, we've already hit our 3 million people, and we're not even halfway through the decade. So now, depends. If Polyev gets in, this thing could go sideways for the next 5, 6 years. It's interesting. And what ripple effects will that have if it does just go sideways and hold steady? I don't know.
I don't know either. And we have to consider the reality that we face, which is if we don't start to have a country that is productive, that has trade, when we look at commodities beyond just oil, when we look at manufacturing, when we look at all of those kind of issues that are currently kind of shut down for all intent and purpose, we have to transition from depending on immigration to actually being productive and driving an economy, not just on consumerism, which has been happening. And by the way, on housing. So as housing has slowed down, and this is something I want to just touch on, as housing continues to slow down in terms of development, again, we're going to see those construction jobs and that industry related, because we can't step over the fact that as the real estate industry continues to slow down, it makes up between 8 and 10% of our economy. So an 8 or 10% factor when we look at a slowdown is going to catch up to us. And that's why it's hard to look economically and be positive economically into the future over the next, let's say, 12 months. That doesn't negate what I've said before, is real estate is still, this is where opportunities exist. And that's where people sit on the sidelines and then regret it in a year from now.
Yeah, this chart indicates that GDP you're talking about, Patrick, especially GDP per capita. You can see GDP per capita is, and in case people don't know, because a lot of people don't realize this stuff, Patrick, but GDP per capita is total GDP divided by divided on a per person basis. Essentially, that's what per capita means. So total GDP doesn't look like it's coming down. And it's not, because of the influx of immigration. But on a per capita basis, you could really see it. You see that nose down on that final tail of GDP per capita. That's because on a per person basis, productivity is going down.
Right. And there's such a lag to it. That's why I say the trajectory is just wrong right now. And before that reverses trajectory, we're going to go through some more pain. I don't know how we can avoid it, to be honest with you. And so those are all the things that we have to pay attention to as we go, when we see what's happening economically, how we use our strategies or tactics as real estate investors, or even if you're a small business owner, a business owner overall. I mean, these are things that we have to pay attention to so that we know and we can put a strategy and a plan in place.
The opportunities are out there, but you got to be willing to, as my former mentor used to say, opportunities are showing up. They just are dressed up in overalls and they look like a lot of work right now. And that's 100% true.
We hear it all the time. It is a grind. I don't know of a business owner right now or anybody in the real estate that isn't saying it's a grind. It's harder work. We're working twice as hard for less than we did in the previous years. Everybody's going through this whole understanding that things have slowed down dramatically. People have tightened up. And here's the thing about it. They tightened up because, number one, they don't have as much discretionary income, which does not do the economy any favors, for sure not. They're looking and hearing about what's going on, Russia, Ukraine, potential war, potential nuclear. All of these things are what's creating the fear, and people keeping their hands in their pocket. They're building their savings accounts, it's because they're trying to plan for what might be an inevitability. And so these are things that are starting to have an impact on the overall economy. But then on top of it, many are waiting for prices to come down, and we don't talk about it enough, and it isn't definitely not talked about in mainstream media. The supply chains are continually being interrupted and have been being interrupted for the past 4 years. None of that has really improved in many sectors. So we're going to continue to see food prices stay elevated. We're going to see the kind of chop of fuel prices, for example. We'll see some balancing in the rental market in terms of rents, but even rents aren't going to go through the floor. They're in fact going to stay where they are or increase over time. So when we look at the actual cost of living, given broken supply chains, given what's going on, people are going to have less discretionary income. And then add to that all of the additional taxes that seem to be showing up in, and we use carbon tax as one example, but it's consistently chipping away at our discretionary income.
Yeah, it'll be interesting to see because we always talk about it, Patrick, especially at REIN, how politics is an influencer, not an economic fundamental, but there's about to be some major influencer. The US election is going to play a role in Canada. And then, Canada 1 year later is going to be at the polls for sure, I think, maybe sooner. And that's going to play a role. So it's going to be a very, very interesting and exciting what's coming down the pipe. That's for sure.
Yeah, we have to stay tuned, stay engaged, keep learning. REIN community, get out to member meetings. We're going to keep talking about what's going on economically. Stay engaged, stay in the network, surround yourself with like-minded people. We got this. So that's another episode of Rein It In. We covered a lot of ground. And as we get through September, we have got a lot of events coming up. We've got a lot of things to talk about. Stay tuned, stay connected to the REIN calendar. You'll see us there. So if you like what you learned here, go to the description below and subscribe for our free Insiders newsletter, where you can also stay up to date for our upcoming events and our courses.